This is one of the best books about money that has ever been written. I just reread The Psychology of Money for the third time, and while the book is filled with timeless lessons about money, in this video I'm going to share the 5 most important lessons that specifically apply to investors. Now, lesson number 1 is about the extraordinary power of compounding. Here's a question for you. Would you rather receive $100,000 a day for 30 days in a row, or a single penny on day 1, but that penny doubles every day for that same 30-day period? Now, if you're like most people, your first thought is to go for the $100,000 per day, but that's actually the wrong choice. As this table clearly shows, if you chose option A, you'd get your $100,000 a day, and by the end of the 30-day period, you would have $3 million. Not bad. However, if you chose option B, you'd start out incredibly slow with just 1 penny per day, but because that money is doubling each period, or compounding, you'll actually end that same 30-day period with $10.7 million, which is more than 3 times as much money thanks to the incredible power of compounding. Now, that almost seems too incredible to believe, but here's a chart that shows that exact same data visually. But after day 20 or so, the compounding really starts to kick in, and that's when the power of compounding really shines through. Now, this is why Housel pounds home the importance of understanding compounding in the book. Now, compounding is simply the idea that your earnings over time generate their own earnings, which creates a runaway snowball effect. Now, Housel says that the human brain has a hard time wrapping its head around this concept, but one way to visualize this is to think of compounding like a small acorn that grows into a mighty oak tree. At the start, the acorn is just a tiny seed, and its growth is so small that it's easy to overlook. But as time passes, with each passing year, the oak tree gets bigger and bigger at a faster and faster rate. And after enough time passes, the tree becomes so massive that a single year of extra growth produces an absolute enormous amount of total volume. Now, investing works the exact same way. Even if you start out with a tiny amount of money, as long as you give that money time, patience, and consistent compounding growth, it can become something that becomes absolutely immense over a long enough time period. And this is why starting to invest early, even with small amounts of money, can lead to incredible wealth accumulation. Now, in the book, Housel uses a statistic that's almost too crazy to believe. He shows that 95% of Warren Buffett's immense wealth was generated after his 60th birthday. It took that long for compounding to really kick in, and now Warren Buffett has so much money that even a single year of extra growth is producing extraordinary returns for him. So the lesson for investors is clear. Compound interest is your most important ally when it comes to investing. Now, that brings us to the second crucial lesson for investors, which is the power of saving money. Which of these 2 scenarios do you think would produce more money after a 20-year period? Option A would be someone who saves $100 a month and earns a very strong 15% annualized return. Option B would be someone that saves $300 per month but earns a much more modest 10% return on their money. Well, given what I just said about the power of compounding, you might assume that the higher return wins. But let's do some math to see what really happens. After 20 years of investing $100 per month or $1,200 per year, person A would end up with about $139,000 after a 20-year period. Not bad. But if we do that same math with option B, which is the person that's investing $300 per month or $3,600 per year, and we compound that at just a 10% rate for 20 years, we actually see that they end up with $209,000. So even though option B earned a lower return than person A, they finished with over $70,000 more simply because they invested 3 times as much money. Now, the lesson here is that your savings rate matters more than your actual rate of return, especially early on. And that's simply because you can't compound money that you don't save. This is why Housel points out that building wealth is far more dependent on your savings rate than your investment return. It's not just about how much you earn, but how much you consistently keep and use for investing. This means that a diligent saver with a modest income can often accumulate more wealth over time than a high-income earner who spends lavishly. Now, as investors, it can be easy for us to focus all of our attention on creating a portfolio that generates the highest return. But Housel points out that it's better for investors' energy to be spent on simply saving more money in the first place. And that's in part because investment returns aren't always within our control, but how much income we generate and how much we spend are. And that means for most people, finding ways to earn more income or spend less money is time better spent than trying to eke out a few extra percentage points of return on your portfolio. Now, as an aside, each time I read a book, I write down the key lessons and they turn them into visual graphics to help me remember the lessons. And I compiled 10 of those visuals into an ebook that breaks down some of the most popular investing books of all time visually. If you want a free copy of that ebook, just visit longtermmindset.co/10 ebooks or click the link in the video description. Now let's delve into the third crucial lesson for investors, and that's on the importance of a margin of safety. Housel emphasizes that the world is unpredictable, and even the best plans can go awry. And that's why having a margin of safety in your investments is so critical. Imagine that you're driving a truck with 9,999 pounds in it, and you come across a bridge with a 10,000 pound maximum capacity. Would you cross it? Probably not, because you know there's no room for error and you're risking your life if something was to go wrong. But would you bat an eye about crossing a bridge with that same truck that had a 30,000 pound max capacity? Of course not. And that's because you know there's a substantial margin of safety under that scenario. Now in the book, Housel reminds readers that survival is the single most underrated skill in investing. And some investors fail to survive because they don't give themselves any room for error. They use leverage and options in good times to juice their returns because they assume that the future will look exactly like the recent past. And that's when life happens. They get hit with a job loss, a surprise medical bill, or a bear market. And if you don't have a margin of safety in your portfolio and in your life, those events don't just set you back, they knock you out of the game completely. This is why a margin of safety is so important. It's the space between what could happen to you and what you need to have happen. So in investing, a margin of safety could simply mean holding more cash than might feel optimal. Most people think that holding cash will actually slow them down. But in reality, if that cash keeps them in the game, especially when life happens to them, that will allow compounding to actually work its magic. That's because compounding only works if you stay invested long enough to let time do its thing. And it's time, not brilliance, is what actually builds wealth. And that brings us to our fourth crucial lesson for investors, and that is the intertwined concepts of luck and risk. Now, we all like to think that investing is a game of pure skill, and that if we just study harder or read more books or analyze more companies, we'll always come out ahead. But Housel makes a powerful point. Outcomes in investing are a mix of skill and luck. And luck, by definition, is something you can't control. You could make a brilliant investing decision at the wrong time and lose money. Or you can make a careless decision at the right time and look like a genius. This is why humility is so important. That's because the market doesn't care who deserves what. It simply rewards whoever happened to be on the right side of the probability on any given day. To see what I mean, consider this visual that shows the returns of the S&P 500 by a variety of holding periods. Over a one-year period, returns have ranged from up 52.6% to down 43.8%. Now that is an enormous spread, and which one you experience in any given year is due entirely to luck. But here's the good news. The longer you hold, the less luck matters. Over a 10, 20, or 30-year holding period, the randomness of those year-to-year returns starts to smooth out. As the up and downs begin to fade away, the average annual return starts to gravitate back towards its long-term historic norm, which for the S&P 500 is around 9 to 10% return per year. And this is why time is the great equalizer. It turns luck into averages, and it separates short-term noise from long-term truth. So when you recognize the role of luck, you become less arrogant about your wins and less ashamed of your losses. You realize that even the best investors in the world get lucky sometimes and unlucky other times. Understanding this doesn't make you cynical, it makes you resilient. Because instead of trying to control the uncontrollable, you focus on the things you can control, like your behavior, your patience, and your ability to stay invested through the randomness of short-term luck. And that's how you win in the long term, not by trying to outsmart luck, by simply surviving it. And that brings us to the fifth crucial lesson for investors, and that is to understand the impact of tail events. Housel makes a point that most investors overlook. It's not the average days that shape your results, it's the rare ones. In investing, these are called tail events, and they're outliers, the handful of days, years, or decisions that end up shaping everything that comes after it. Now, most of the time, markets are ordinary. They go up a little and down a little each day. But every once in a while, something extraordinary happens. A crash, a bubble, a breakthrough, a pandemic, and in those rare events, those tail events, explain the majority of our long-term outcomes. Now here's a visual that's almost too hard to believe, but it's true. If you look at the data, just a few of the best performing days account for a huge share of the market's total returns. In fact, if you miss only the 10 best days in the market over this 20-year period, your total return would nearly get cut in half. That's the power of these tail-related events. They don't just influence the results, they define them. Now, here's the hard part. You never know when a tail event is going to happen. No one can predict the next financial crisis or the next bull run. And that's because the goal of investing isn't to forecast the future, it's simply to be prepared for it. Because missing just a few of those rare, positive moments can undo years of smart decisions. And ignoring the possibility of the rare, negative ones can actually wipe out decades of progress. So, what can you do? Well, you should simply build systems that allow you to survive extreme events. Good systems will allow you to stay invested so that you're around to capture the big upswings, and good systems will allow you to maintain a margin of safety so you can endure the inevitable downturns. Because in the long run, your success won't be determined by what happens on most days. It'll be determined by how you handle the few days that truly matter. Now, as a friendly reminder, if you want a free copy of the infographics that contain some of the key lessons that I've learned from 10 of the most popular investing books of all time, simply visit longtermbalanceit.co/10 books and let me know where to send a free copy. Well, overall, The Psychology of Money is a fantastic book, and it contains far more lessons that can be covered in this video, and it's one of those rare reads that will change how you actually think about both money and life. So if you haven't read it yet, I highly recommend picking up a copy and reading it yourself. And thanks for watching this video. I'm Brian Feraldi. I'll see you in the next one.